Welcome. Most of us dream of owning a home, but the path to get there often feels like an uphill battle. Traditional financial advice tells us to diligently save for a down payment in a safe account. But what if that advice is fundamentally incomplete? Today, we're going to uncover a paradigm-shifting insight called hidden alpha. We'll explore an unconventional strategy that reframes your down payment not as a savings goal, but as your most critical growth investment on the path to securing your dream home and building generational wealth. The first step is to grasp a concept we call the opportune inversion of capital appreciation, or OICA. Traditional thinking separates your down payment savings from your investments. This is a costly mistake. The OIK principle states that for many of us, the most critical capital appreciation in our lives isn't for retirement, it's for the down payment on our home. Think about it. Home prices, especially in desirable areas, are often rising faster than any high-yield savings account can keep up with. Consider Sarah, who saved diligently for 5 years, only to find her target home had appreciated so much her down payment was no longer enough. She was a victim of the traditional savings lag. The key is to harness the same market forces driving home prices up to accelerate your own capital faster. So how do you know if this strategy is right for you? You quantify it using a framework called the Home Equity Multiplier, or HEM. This isn't about timing the market. It's about timing your capital accumulation relative to the market. The formula looks at 4 key variables. First, the projected annual growth rate of your equity portfolio. Second, the historical growth rate of your local housing market. Third, your total down payment target. And fourth, your current savings. Plugging these in gives you your HEM score. A score greater than 1 suggests that a growth-oriented equity strategy is likely to outperform traditional savings, helping you outpace housing inflation. A score less than 1 is a signal to reevaluate your investment plan or perhaps adjust your housing expectations. It's your personal data-driven guide. With your HEM calculated, it's time to implement the strategy. We call this dynamic down payment allocation. Instead of putting 100% of your down payment funds into a savings account, you segment them. Allocate the majority, say 70 to 80%, to what we call the growth accelerator. This is a concentrated portfolio of high-conviction, growth-oriented equities you've researched. Think sector leaders, not speculative gambles. The remaining 20–30% goes into a stability buffer, a liquid, high-yield savings account or short-term ETFs. This is your safety net. Finally, as you get within 18 to 24 months of buying, you implement a de-risking glide path, gradually moving money from your growth accelerator to your stability buffer. This locks in your gains and protects you from short-term market volatility right when you need the cash. Let's bring it all together. The journey to your dream home doesn't have to be a saving slog. By inverting the traditional model, you stop treating your down payment as a static savings goal and start treating it as a dynamic investment. You use the Home Equity Multiplier to create a data-driven plan, and you implement a dynamic allocation strategy to balance growth with safety. This proactive approach directly links your ability to secure a valuable life asset, your home, to your skill in the capital markets. Your home should be the ultimate manifestation of your investment success, not a hurdle created by financial myopia. Thank you.